Thanks everyone for being here. I'm Capsuto. I'm a partner in the private companies group at Cooley. I'm going to do some real quick intros of our panelists and then we will dive right in. So immediately to my right is Heidi Patel. Heidi is a managing partner at Rethink Impact, the largest US venture capital firm investing in female-led mission-driven tech companies. She sits on several boards, including Icon Savings Plan, Full Harvest, and Clarity Pediatrics. Previously president of New Line Capital, Heidi oversaw more than 100 impact investments across sectors from sustainability to education. She also teaches impact investing at Stanford GSB and serves on GSB's Student Impact Fund's Investment Committee. Next to Heidi is Adam Sterling. Adam is Associate Dean of Executive Education and Strategic Partnerships at Stanford Law School, where he leads programs for alumni, legal professionals, and organizational leaders. Formerly Assistant Dean at Berkeley Law and Executive Director of the Berkeley Center for Law and Business, Adam has taught and published on venture capital, entrepreneurship, and corporate governance and leadership. He began his career as a startup and venture capital attorney. Next to Adam is Dawn Belt. Dawn is the managing partner of Fenwick and a partner in the firm's startup and venture capital group. Recognized among the top women leaders in technology law, she guides emerging and high-growth companies through formation, financings, and exits, with deep expertise in M&A, IPO, SEC compliance, and corporate governance. Finally, Chris Trester is a partner in Gibson Dunn's Palo Alto office and chair of the firm's emerging companies and venture capital practice. He represents startups and investors through every stage of growth, from incorporations to financings and exits, particularly in tech, entertainment, and life sciences. Before practicing law, Chris worked in audit and transaction services at a Big Four accounting firm. So obviously a very esteemed group of panelists here, and four folks very adept at talking about valuations. So excited to discuss with the group here today. So we'll start out kind of broad. We have a few themes we're going to move through, but we'll obviously have to be very conversational and see where the discussion takes us. So we'll start with just, what are some of the trends that you see in valuations today? And Dawn, we'll kick it off with you.
Yeah, so bear with me a little bit. I'm actually going to give you a few statistics. Fenwick partners with JP Morgan and Omni to publish a venture beacon report every quarter. We're not quite done with our Q3 yet, but as of the end of the first half of 2025, there were certainly some trends that we were seeing, and primarily early stage financings are still very, very resilient. We're doing well in that area. Series seed through C rounds during that performance were really up. Deal sizes were up 5 to 22%. Valuations were up 3 to 60%. So that's quarter over Q1. So the earlier stages, early growth, all doing very well. Where we did see some decline was in Series D and later rounds. And in those rounds, we had declines of about 9% in total capital raised, and in valuations down almost 50%. Now, part of that is probably some exuberance in 2024 and the earlier part of 2025 with a lot of super big rounds. And you also have a little bit of a smaller numbers problem in there, so a lot of noise. But what we are still seeing is a ton of early stage activity. It's really quite robust. Those seed rounds also tend to be much larger now. I think companies are able to raise more on safes and just keep their whole transaction process really quick and easy, which is fantastic for them. The other metric that we thought was quite notable was that what we call graduation rate. So what percentage of seed companies actually are able to raise their A round within a year or so of that initial seed. And that number was up to 21% compared to 12% the prior quarter. So that's a really good sign that it's essentially higher quality companies are getting funded and then being able to raise again, right? So you don't just want a whole bunch of activity. We saw that during the pandemic years, right? Everybody with a business plan could get some money, but that doesn't mean that they were actually able to create a product and move forward to the next stage. So that kind of robustness has been quite positive. We're also seeing a lot of secondary market activity still, not giant necessarily. A lot of the average tranches of these secondaries were just in the $1 million to $1.5 million, so not a giant amount of money, but people are getting some early liquidity. So really still good signs, I think, in what's happening, and I'm sure folks have some anecdotal things to add to that, but it is not doom and gloom, even though there is a ton of uncertainty I think we're all feeling.
Great, thank you. Chris, I'm curious if that kind of jives with what you're seeing with later stage companies and deal structuring and acquisitions.
Yeah, I mean, certainly, I think some of the interesting things I'm seeing with the later stage companies is obviously you have your LLMs or sort of those big AI names that are out there, grabbing the attention with some really big rounds. But you also have some of these late stage companies that, they've had they have their own business. They have their own sort of product that's out there that they've been working on for 8 years or so, but they want a piece of this valuation jump in this bubble that's out there. And so what I'm seeing is some very interesting ways of trying to sort of get a piece of that market. I mean, one thing that sort of was a public thing that came out was, for example, Uber, which is not a private company, but it's having its drivers now work on training data sets while they're working at the gas pump or anything, because they have the users, they have them sort of built into their platform, and the acquisition costs are maybe easier at that stage. So I'm seeing a lot of late stage companies that are thinking about creative ways to sort of get on this bandwagon from a valuation front.
Does that include adding .ai to their?
Yes, so I mean, that was the way a couple of years ago, was to just, I had a client invest in a AI-powered trash can, but I think now we actually have real sort of value that people are trying to create.
Great, thank you. Adam, would love to kind of bring in your perspective on the policy side, kind of what you're seeing in terms of law and policy shaping founder and board behavior. I know you have a lot of experience working with boards and executives, and would love to kind of hear, obviously we're hearing, AI is a theme through all of this, and would love to get your perspectives on how you're hearing that play out.
Yeah, so I run this program with the National Venture Capital Association called BC University. It's in its 6th year. And so we sort of train aspiring and emerging venture capitalists. And in the first sort of session, we talk about the power law and the sort of the dynamics of the industry. And I think sort of what we're seeing happening both on the sort of the AI level and in Washington and beyond is sort of reinforcing the haves and have-nots in a lot of space. And I think this idea, when Sam Altman was sort of briefly fired from OpenAI, and there was talk about him starting his own firm, and if he walked into any office, he would have sort of named his price without even having a business plan. And so I think in sort of in the AI space with things like that, these sort of, I don't know, they're called reverse acqui-hires, just sort of crazy things happening. But then in a lot of interesting spaces, it's business as usual. And so I think separating the signal from the noise is increasingly difficult. I know Heidi's going to speak to that, but that's sort of the challenge I think we face.
Great, thank you. Do you want to pick up on that thread a little bit, Heidi?
About
But separating kind of like the signals from the noise. Yeah.
Yeah, I mean, I think it's really challenging. I mean, venture has changed so much, even in the last 6 months, let alone in the last few years. And I think what you're saying around the have and have-nots, I see that all the time. There's just an enormous kind of barbell structure to how deals are getting done. So you have, on the one hand, folks that are building these foundational models. Oftentimes it is groups of second-time founders, third-time founders. They have a huge track record. And so that is absorbing a ton of the attention, capital. And a lot of that, frankly, is driven by the opportunity and potential for really rapid growth. Part of that is driven by increasing numbers and sizes of mega funds, so VC mega funds, who just are desperate from places where they can write 9-figure checks, if not 10-figure rounds. So that's starting to like really distort the market. And then you have, the VC land is very similar in this barbell approach. You have really big mega funds, and you have lots of specialist funds who cannot and will not write checks of that size. And so what's interesting that's happening in these other markets is may or may not have repeat funders, but I'm starting to see phrases like rule of 40 be mentioned in like Series A, Series B rounds, which is wild. It's just wild.
I know some folks are familiar with that and others might not be. Could you describe that? Yeah.
So basically, like, are you profitable? Are you on a clear path to profitability within the next, 6 to 12 months? I mean, we have not seen that in early stages, I think, ever, and I've been doing venture for, over 20 years. And it's just really interesting because there's definitely two games being played. I mean, I'm seeing a lot of Series B, Series C deals getting done when typically you're seeing like $8, $10, $20 million in revenue. I'm seeing a lot of Series B and Series C deals where there's no revenue. And they're massive valuations because there's a big idea and a great team. So then you have companies that are actually building and they're embedded in customers and they're gathering like actual real-time data and really working on commercialization as well as technology. And so it's anyone's guess like how that shakes out. Like maybe these companies, when they go to raise a Series D and they've got $2 million of revenue, like does the bubble burst at that point? I don't know. So are all these kind of more, companies at the grindstone, working it out, building revenue and go to market alongside tech? Hopefully those are going to be really well positioned because that's where all of these emerging manager smaller checks are getting written. But time will tell.
And is it the companies that are AI native versus not, the ones that are kind of able to raise with revenue versus not? Is that the distinction, or is it something else that you're seeing kind of driving that difference?
Sometimes yes. Sometimes it's are they building something that has massive absorptive capacity? So can these mega funds see, I can see a path to writing multiple super large checks, check sizes that are bigger than almost all emerging managers are for a whole fund. But a lot of times it's a lot of the sizzle, right? Who's on the team? Yeah. Have they worked together before? Have they achieved exits before? Is there are they a known entity or not? And so if you're not AI native, you're not a known entity, you have your work cut out for you. And so that's where the goalposts to get a seed or an A done are moving in a way that's super challenging for founders.
Yeah, and obviously creates a lot of challenges too around oversight. Like how do you create governance around that on a board when there's just so much churn? It's so hard to kind of figure out where there's real value. Dunn, would love to kind of hear from you on this specifically, how you're seeing boards and companies manage governance and oversight as they experiment with AI tools.
Yeah, so I think we are seeing more focus on that, like in boardrooms, board members asking about how AI is incorporated, and then lots of, obviously in just terms of moving fast, people see it as like some kind of snake oil almost to solve every problem, right? But there is an element of how are you using it in a responsible way? And we're certainly seeing companies, I have a client, SurePath, that they are actually developing a platform for AI compliance. So the idea is like your product people want to use AI, but are they using it in a way that's still protecting your business? Are you just using it as like a free intern, right? Giving it all this information and access and have no idea whether you have a big security problem, data leaks, do you own the stuff that you're creating, all of that. And so from a legal perspective, which I think most of the folks here in this room are lawyers, like are you working closely with your product folks so that they understand what it is that what are your policies? Are you able to enforce them? Are you able to do the training and compliance? Do you use tools within your company to help monitor all of that? I think that's a new piece of the compliance framework that in-house lawyers really need to be thinking about. And that you got to be reporting on that to upper management and to the boards, because that could have fundamental knock-on effects if you find out, we created all of this stuff and actually it's not clear we own it, or our license to the data set is not so clear, or whatever it might be. Making sure that you've got a handle on that early on is going to be really important.
Thank you. Do you want to add anything on this topic, Adam, before we?
It's interesting, right, that the topic of this session is building real value in a shifting VC landscape. But value in venture world is it's subjective, right? And it's sort of what does your sort of next investor value, and how do you build momentum, and so people, the Valley likes to project itself as being contrarian, but it acts in very conformist ways, and so this is the shiny new thing, and maybe the bull case is that it's sort of the next internet, and so building on top of it is what everyone needs to be thinking about. But I think it's hard to sort of distinguish between real and sort of arbitrary value, because it's sort of the market determines what's valuable.
Yeah.
And value may be ephemeral, right? So we spend a lot of time in the clinical nutrition space, and there are a number of venture-backed players, and the three biggest now are under multiple class action lawsuits. And it comes from this pressure, I think, that founders are under from investors and just from their own, what do I want to build? Who do I want to be in this world? And they're moving so quickly, and lawsuits are around extractive behavior towards their clinical workforce, violating privacy laws and customer acquisition. And so what is value? I mean, some of these are billion-dollar businesses. So are they worth that? Is that their value? Or does that all come crashing down because they don't have good governance in place? And are the good citizens getting rewarded? Not necessarily. So it's just interesting to think about value being ephemeral and shifting.
Yeah, absolutely. Great. Well, we're going to shift a little bit topics and talk a little about the evolving VC landscape. So some of the kind of less traditional players and how we're seeing some movement there. So Chris, would love to hear from you on how corporate investors are influencing deal terms and expectations around exits compared to traditional VC investors.
Yeah, so I work with a lot of the corporate VC, and I think sometimes some of the first question you have to ask is what does value mean to them? For your typical VC, it's pretty simple. They're looking for a rate of return, over a host of different investments. For your corporate venture, you may or may not. Some focus and prioritize more on return. Some are looking for some kind of commercial relationship, and the return is secondary. And so as they get into more and more rounds, and we're certainly seeing, the hyperscalers and the chip players, but just even outside of there, I think corporate VC is much more prevalent in the market these days. Why are they getting into a round? And some of them are even more comfortable in leading it. And sometimes that involves strategic partnerships. And these partnerships may have a term sheet that's focused on the investment terms, but it's equally focused on commercial terms and can be complex and long-ranging. You may even have sort of issues they put in there regarding maybe trying to box out competitors, as much as you don't want to say that, right? But they might want to understand if a change of control notice comes in, or so that they have a seat at the table. Will they be able to invest more in the future? And so some of these might be more long-range views, and as you go to seek their money, you have to be somewhat comfortable that there might be this conflict between your typical VC investor, who may be looking more at a short term, we want to commercialize, maybe sell on a quick basis, whereas maybe the corporate venture is thinking that this is going to play out over a much longer period, and maybe you're a hedge bet to what they're currently doing, or they're thinking of you strategically, and this is a partner we want to grow for 5, 7, 10 years. So I think that's just something that's sort of, as they grow to be a bigger portion of the market and in much more rounds, something that folks have to be cognizant of how that relates to the typical VC market.
It also seems like corporate venture is far more sophisticated than it was. Even, I don't know if you're seeing that, just sort of understanding deal terms, who they hire as lawyers, and
Yeah, agree with that 100%. I think there was, I don't know, maybe 10 years ago when it really started to get a little bit of traction, and frankly, I think a lot of companies saw it as sort of relatively dumb money, right? I don't think that's the case now. I think it's much more sophisticated, and to what Chris said, it can be complicated, right? In terms of what information are you sharing with these folks? Their interests may not be entirely aligned with the company and your strict financial advisors. And as lawyers working with companies that may be taking that type of funding, how do you negotiate walls and abilities to keep certain information away from them, exclude them from certain conversations, yet also take advantage of the commercial partnership that they may bring to the table? I think that's a tricky line to navigate.
Yeah, especially who sits on the board, who's an observer, you know. I mean, often they want, even the portfolio company, they want the person that they're going to be dealing with on a day in and day out basis like to be on the board, but that may not always be the best for both parties for numerous reasons.
Yeah, Adam, have you seen that play out kind of in any of the trainings that you're, any of the work you're doing with boards? I guess either the role of corporate VCs or has that changed the dynamic?
They're usually here, right? Like, so I know the folks from Salesforce Ventures, they don't take board seats, and I think there's others like that. So I think that's right, just sort of understanding what your motivations are, and then sort of how does that interact with sort of the deal terms that you negotiate for, the governance structures, and sort of, I think there are ways, even though we tend to sort of templatize things and follow the approach of what others have done or what we've done before, I think there are ways to be thoughtful and to,
Yeah, just as a specific example of that, actually, I think at the beginning we were seeing a lot of corporate venture say, we want a board seat just because it seems like a good thing to have, right? Like, of course we want a board seat, we're putting in this money. And then they realized, wait a second, if I take the board seat, I have certain fiduciary duties to the company, I don't want those, right? So I do not want a board seat, I just want to sit there and be able to listen and then advocate 100% for myself. So in the observer seat, they've kind of come around to realizing that's actually more advantageous for them, right?
That's really rough for founders, because then you have your corporate VC in the room, but they don't have fiduciary duty.
Correct.
So that's, I think, can be very, very tricky. That said, we work at Rethink Impact, we work a lot with City Impact Ventures, Salesforce Impact Ventures, MassMutual. They can be extraordinary partners, and they have a lot of resources behind them where they can help founders get on stage. Like, they can do a lot to promote their companies on top of working towards commercial agreements.
Right.
But it's not without strings and some of these catches, particularly in the boardroom. And kicking people out in the middle of a meeting, you got to build muscle around that. And I think founders who are first-time founders have a hard time understanding it's okay. You can say, like, we're going to go into closed session. You can pop out, corporate
and
person.
I might chime in, that's actually a place as an in-house lawyer, if you are part of the board team, that may be a place where you can really help your CEO by being the bad guy, right? Like, and saying, look, this is whether there is actual privilege or not, or at least some sort of sensitivity to be the one that says, hey, this is the time that we're going to excuse certain people from the boardroom and absorb a little bit of that heat for your
founders will love you for it.
Or does it make sense to have two, not to have one lead, but maybe have a couple different leads, and then at least you have them all there, like all policing each other, each one of them hearing at the same time, right?
Great, thank you. Adam, curious to hear from you kind of what lessons founders and boards can gather from prior market cycles to sort of, act on today. Sort of what's different in the boardroom now versus 5 or 10 years ago, and maybe it's the role of corporate venture or other trends that are playing out now versus in the past.
Yeah, when I practice, right, I think the board governance, at least in the private markets, was an afterthought, right? Like, we'd send an associate to the board meeting because we didn't charge for attending board meetings, and then minutes where questions were asked and answered. And I think the dynamics are becoming more complicated, more thoughtful. We have now, case law, trade-offs that sort of, I think I am seeing more attention on private company governance and founders earlier on thinking about the composition of their board, taking advantage, actually appointing an independent director. Remember for years, right, after every financing, we'd create the sort of mutual or independent director seat, but that would just stay vacant. So I think companies are starting to realize that they can get better people earlier on than just sort of waiting to pre-IPO to take advantage of that. So I'd love to hear what you all are seeing, but I think there is more thoughtfulness around governance in private companies.
I mean, I would jump in and just say, in a weird way, you look at some of these mega rounds,
Right.
and
Yeah.
so many people have invested, and the details of them have gotten out that almost every founder that I'm talking to is, well, so and so has, the founder has a right to control a majority of the board, or they have their own protective provisions, or they have 10x voting stock, 100x voting stock, founder preferred stock that has some crazy rights in it. So in a weird way, some of the founders in these AI spaces have found a way to almost like shift the control and where the governance, and the investors in a weird way, they're so excited to get into these rounds that they have sort of ceded control in a lot of interesting ways that you would never think about at your prototypical company. And you have a lot of people who may not be in the same positions as those companies, but they've seen it, they've heard it,
Yeah.
and they want it. And so there's some dynamics playing out there.
Heidi, you're nodding. Would love to hear.
Oh, yeah, I mean, that's, just because the haves have what they have, I mean, the have-nots want it, right? And they're like, okay, even though I'm like a first-time founder and this is a small company and I'm raising a small round, I want 10x founder shares, right? 10x voting shares. And it becomes this like, in these moments where you've put a term sheet down and you're negotiating with founders, that's where I feel like everyone's true colors come out. And so when you have these like tricky, sensitive things that come out in these moments, it can be really hard because you don't want to be telling a founder like, well, you're a have-not, right? So like, I'm excited to back you, but like, you don't have like 3 successful exits behind you. You're not raising $200, $300 million. This is like a $10 million Series A. Like and it's because you don't want to tell someone like, hey, there are these, the barbell conversation does not go well with founders in that moment. You can't just explain it. So it's just one more tricky thing to navigate in a moment where you're actually really trying to build trust and build a long-term relationship that you're going to have for the next 7 to 10 years.
Yeah, but I think being able to have actually that conversation as a legal advisor in particular can be a way to build trust, even though it is not necessarily a message like anybody wants to hear, as you said, Heidi, right? But can you manage that conversation in a delicate way that actually helps people focus on what's important, right? Because I agree with Chris, like all these stories we're hearing in terms of what founders are able, some founders are able to do as far as their own powers and rights, the economics are nuts, the governance is crazy or non-existent, and all of these things. That's still not most companies.
Yeah.
And not most companies that can still make money, by the way. Like there's lots and lots of opportunities to create good companies that don't have all of those bells and whistles, but will, if you raise 10 to 20 million and you sell for 150 to 200, you're going to do really, really well, right? And staying focused on that type of almost bread and butter, which is still, I think, most of our practices here, is valuable and is a way to create value in this VC landscape, notwithstanding a lot of the noise and shiny objects that are floating around also.
Basically, the challenge is we don't sort of bifurcate, right? And so going back to sort of these massive funds, like those numbers don't work for a massive fund, right?
For sure.
Are you all seeing, I sort of heard this morning in office hours where historically with the board comp, right, there was this conversation about whether one of the common seats would be tied to the CEO of the company, but then I heard increasingly there's a push to have one of the common seats tied to the founder of the company. Are you seeing that?
I've seen it here and there. I wouldn't say it's like a trend, but I have seen it here and there. I've certainly seen people ask for it. I still see a lot of investors push back on it. I think investors that have been through the situation where you have the departed founder throwing tomatoes from the upper gallery really realize that becomes a dangerous.
But I do think, though, that the repeat founders, like the folks that are going through it, they have been through some of these challenges and they've played out the board dynamics. And maybe the board dynamics didn't work out the first time they went through the way they envisioned it. And I do feel like there is more thought going into what they are willing to tolerate in the board. And those are the people that I really see pushing for, like, I don't even want an independent for the first couple, right? Like, I want my people that are going to fully support me and I want a board seat, X amount of board seats, and being very careful, honestly, at who they let lead, and wanting those people that they lead to be able to trust as almost an ally for the first couple of rounds.
Yeah, it's a great segue into our final topic, which is building companies that last. So just 10 minutes to cover that topic, no big deal. So Heidi, picking up on your kind of, having that barbell conversation is not a conversation you want to have with founders. What advice are you giving to founders to help them kind of manage through this volatility and really, build companies of real value when it's hard to figure out what real value is when it's, ephemeral?
Yeah. So, I always encourage we do a lot of female founder office hours. We're meeting people really early in their journey. I teach at the GSB, so we're meeting folks early. And I always encourage them to really try to understand the VC landscape and to be able to understand VC math and understand VC fund math. Because this conversation you guys were just having, we're like, for an emerging manager like us, we managed about $750 million. A $200 million outcome is great for everybody. Yeah. That is not even, you may not even get a board member to show up from a mega fund for a deal like that. So part of it's get your VC math, understand how VC fund math works. 2 is pick a lane, right? So there are some companies that are set to have the absorptive capacity where you're going to raise hundreds and hundreds of millions of dollars to achieve a big outcome. And you need to build a business that fits that. Super fast growing, really big vision, incredible team around you, typically are repeat founders. That's not the only way to build. There are lots of different VCs out there, so pick a lane, right? So in 2023, I think there were 3,400 VC firms. 500 of those were formed in 2023. So wow. There's enormous explosion in the number and diversity of VC funds, and a lot of them are looking for different types of outcomes and have different types of strategies and different types of ways to engage with companies. And again, this I talked about rule of 40 earlier on. So, what I say with founders is this is a super unpopular perspective, but you either need to build to be $500 million or $1 billion in top line, or you need to build to be profitable or wildly profitable in short order, or you die. Those are your paths. And they will be funders for those first 2 paths for sure, but you have to know which lane you're in and intentionally build towards that, and then navigate how you approach the capital markets accordingly. And I also tell people, VC should be your last resort. If there's any other way to fund your company, you should do that. But if you're going to play this game, play it well and just be super knowledgeable about how the math works.
Great, thank you. And as those companies are kind of racing towards that, grow or die, Dawn, how are you counseling those companies on balance? Yes, thank you. There's 3 paths. Yeah, sorry, 3 paths. How are you counseling clients on balancing innovation with compliance and governance?
So in that particular context, I'm not sure it's any different, right? I think you think about compliance and governance as actually strengths, right? As lawyers in the room, to think about how do you use that to actually help build the business, not be the office of no. I think what's kind of interesting, maybe it's not so much compliance and governance, but just in terms of the legal work and then supporting businesses and in these paths. I do think actually AI is super interesting, just coming back on that topic, right? You think there was a lot of hype, or maybe continues to be hype, around how AI is going to replace lawyers. Actually, pretty strongly believe that not to be true, notwithstanding, of course, some self-interest there. But I think the idea, actually, as an interesting side note, I did run our proposed questions through ChatGPT for answers, and they were terrible. Okay, you would be so disappointed in this panel if we just gave you the ChatGPT answers. I'll tell you that. It would be really, really crazy. But in any case, what I actually think is this will be a place where we're going to reveal latent demand. So the fact that we're going to be able to do efficient legal services and advice cheaper, faster, more thoroughly, is actually going to have people want more legal advice. So if you think about just a particular example of maybe you run across a question even in your personal life, you're like, well, I'm not going to hire a lawyer because it's going to cost way too much money. But if getting a piece of advice on that costs $100, you might go get it, right? And so thinking about that internally in your teams at companies, are you able to answer more questions for your sales team, for your product teams, for your finance and partnership teams, whatever it might be, that actually has them come talking to you more often? I think that is actually a part of our future. So figuring out how to incorporate these tools to do our job better, faster, more efficiently is important. And that kind of feeds into building the value from a legal perspective. I don't think we're going anywhere soon.
Maybe to tie into Heidi and Don's both together, I always remind, and I just was talking at lunch with a founder about this on Friday, about how raising lots of money comes with its own problems, right? And so knowing what the liquidation stack and how it works, and I know it sounds super simple because but everyone tends to forget that if you raise X amount of money, you have to exit for more, right, to really be a success, right? And if you get so much money, and once again, this is what I was talking about through at lunch, people have a tendency to blow through the amount of cash that they get, and whether smartly or wisely or whatever, right? So many of them, because the founder I was talking to, he was actually founded his company in Korea and had been through a very conservative, sort of VC system. And he was going on a Series E, and he had only raised $240 million for an AI product. But he was talking it through with me, and he's just I don't know what I would have done with more cash than that, right? And some of these that are out raising $1 billion, it's just mind-numbing. And so when I'm talking with clients, some of it is, maybe you have the potential to raise that amount of money, but is that what you really need, And I think that goes back to the math as well. I mean, it's fitting both sides, but it's just something that gets lost a bit in the legal documents.
And a lot of it goes to secondaries.
Yeah.
Right? I mean, I think the whole tech community has been plagued with these extremely long hold periods, and people haven't had exits. So now we're seeing a lot of these big rounds, like OpenAI was a great example, where they took a big part of the cash they had just raised and bought shares from the employees. So they would have a liquidation event very early in that journey versus having to wait God knows how many years for IPO. And that raises its own kind of governance questions.
I'd add for advice, innovate your business, not your legal structures. I think we'll have quite a few folks talking about Delaware, and I think as important as sort of the case law is, what isn't being discussed, or I don't see being discussed, is the process side of it. And I remember when it was sort of hot to move your headquarters from here to Miami or Austin, and then winter or summer hit and everyone came back. I think as soon as folks start seeing, you're finishing a round, you're filing your amended and restated charter, and then it takes 2 weeks to get it back, and you can't get your wire, folks are going to lose their mind. And so I would just, go Delaware.
I support that. Great. I know we just have just 2 minutes remaining. Adam, I hope you can leave us on a high note here. What are you optimistic about as we look to the future of entrepreneurship? Just a small question to leave us off with. Or anyone, and feel free to get Adam off the hook here if anyone else wants to chime in.
Maybe I'll go. I mean, I think that there's never been a better time to start a company. I mean, to be able to do it fast, a lot on your own. Avoid raising VC funds if you have to, or at least until you're quite far along. It's a super exciting time, and I think that there are a lot of opportunities to be seized now if you stay focused on finding exactly what the problem is you're trying to solve and not chase, yes, I need to be in Texas, or I need to have 10x founderships, and all these things that are really not particularly relevant to actually building a business that has value now.
I mean, I would just say both. I think you're going to see, we started off with stats. I think you're going to start seeing in the stats that come in for Q3 and Q4 that we're like the market is kind of taking off. But I mean, I think informally, anyone that's working in deals, transactions, I mean, people are just getting busy again, like really busy compared to how they were in a year or two. And sometimes just that informal chatter is a better sign of the market than even the stats, because if everyone's sort of busy, then deals are out there and they're about ready to be announced and happen. And so, I mean, I think we're, lined up for a pretty good upswing here.
Agree.
I think what gives me optimism is that I think the image of what a successful tech founder looks like and their profile is finally starting to change. We had one of our founders land on the cover of Time magazine a couple weeks ago, and she's young, immigrant, pregnant, and running a multi-billion-dollar business. So
Love it.
yeah.
I can't think of a better place to end off. Please join me in thanking our panelists. Thank you. All right.